Before you start to invest, ask yourself one question. When will I need to use this money? The stock market is a long-term investment. If you need to use the money anytime soon, you should not invest in stocks. This is money you're willing to put in the market and leave it there for 5, 10, 20, 30 years. That's the kind of money you can do well with. If you're worried about it, don't invest it. The stock market is volatile. Individual stocks are volatile. The average range for a stock in a year is 50% between its high and its low. Stocks go up and down. The market goes up and down. If you're investing with a 1 or 2 year time horizon, you shouldn't be in individual stocks. You shouldn't be in equity mutual funds. If you've been lucky enough to save up lots of money to send your children to college and they're starting school in 2 years, what are you going to do if the market goes down? In the long term, 10, 15, 20 years or more, stocks have beaten bonds and banks' certificates of deposits. But in the short term, there's no telling what will happen. In 1987, the S&P 500 fell 33% from its August top to its October bottom. If you had the stomach to ride through that drop, you would have found that the S&P performance from 1987 through 1992 still outperformed Treasury bills and long-term government bonds, despite that decline. If you want to double your money quickly and safely, fold it in half and put it in your wallet. Any other way, you're simply gambling. A good stock can take 2, 3, even 5 years before it really pays off. It's not 2 or 3 weeks. It's not 2 or 3 months. My best stocks have been in my 5th, 6th, 7th year. Give your investments time to grow.